The risk that most people tend to completely ignore and in fact never consider at all when it comes to investing is their emotions. This is easily the most important risk known to investing in my view, and that people tend to make decisions when they shouldn't, that is when they are in a high emotional state. This makes their decisions completely irrational in a lot of cases. There are numerous studies around the world which indicate that the average investor in all sorts of different markets actually manages to underperform the average return of the market they're investing in. The most famous of these studies is one that's been running in the US for years now and measures the return of the US share market versus the return that the average share market investor gets. They found, for instance, in 2009 that over the previous 20 years the US share market had averaged almost 10% a year return, which is a fantastic result over such a long period. In the same period of time, the average inflation rate in America was actually in excess of 3% a year. So what did the average investor get? Less than 2%, 1.9% per annum in fact. This is a disastrous result. And it results from the investor panicking when the market goes bad and getting out, which is a totally irrational situation to be in, as the asset will never get any cheaper than it is when it's at the bottom. And when the market is on a roll, they tend to leave investing until it has been rising for an extended period of time and jump in when the chances of any sort of good return are logically gone. What we have here is a perfect example of emotion ruling intelligence and brings to mind Warren Buffett's oft repeated quote, which is, "Be fearful when others are greedy and greedy when others are fearful."